What is up, guys, and welcome to another edition of the Market Marauder Show. Be in the market one trade at a time. Hope everybody's having a great week out there, able to lock in some profits. All right, so in this episode, I'm going to be talking about the Tesla earnings. So Tesla's earnings was given out today. After its earnings, Tesla has fallen 6.03% to $169.70, so down $10.89 on the day, and still falling. So basically, this is going to be a breakdown of what Tesla's earning was and what happened to cause the stock to go down so far. So Tesla stock is slipping after the bell as the electric vehicle maker reported slight revenue and profit misses and gross margin that dipped below 20% to 19.3% at the cost of recent price cuts hit profitability. For the quarter, Tesla quarter one revenue of 23.33 billion, slightly below street estimates of 23.35 billion, with Q1 adjusted EPS coming in at 0.85, below street estimate of 0.86. That revenue figure for Q1 represents a slight dip from the 24.32 billion Tesla reported in Q4, but still 24% higher than a year ago. So year over year, they're still 24% higher, but quarter over quarter, it has slipped significantly. On the profitability end, Tesla reported adjusted net income of 2.9 billion, less than the 3.03 billion estimated by the street, and a billion less than last quarter, around 700 million less than a year ago. With revenue staying flattish and profit dipping, the effects of the margin compression could be a play here. So they're saying the margins with the price cuts combined is what's making them miss this number by 2.9 billion versus the 3.03 as expected. So it says, although we implemented price reductions on many vehicles across the region in the first quarter, our operating margins reduced at manageable rate. We expect ongoing cost reduction of our vehicles, including improved production efficiency at our newest factories and lower logistic costs, and remain focused on operating leverage as we scale. And this was a statement that came out by the company themselves. Looking ahead, Tesla still sees 2023 global production at about 1.8 million vehicles, with its long-term delivery growth rate staying at 50%. Tesla also said Cybertruck production is on track to begin later this year at Giga Austin, with the company producing alpha or early test versions of the vehicle. Tesla instituted a number of price cuts in the USA, Asia, and some European markets in Q1 of this year. Gross margins dipping to 19.3% may reflect the cost of those price cuts. And last night, Tesla slashed prices of the Model 3 and Model Y EVs yet again, in fact, bringing one of them below 40,000. Yesterday, price cut is the sixth one this year by Tesla in the U.S. Saw each version of the Model Y SUV slashed by 3,000 each, with the Model 3 rear-wheel drive dropping by 2,000 to $39,990, and the base Model Y, known as the all-wheel drive or all-wheel drive version, now starting at $46,990. Tesla has now cut prices of its base Model 3 by 11% this year alone, and its base Model Y prices have fallen by 20%, according to calculations done by Reuters. These last price cuts come as federal government limited the number of vehicles eligible for the electric vehicle tax credit, with Tesla's base Model 3 rear-wheel drive seeing its tax credit fall by half to $3,500. Wall Street banks such as Evercore ISI have attempted to qualify the price cuts. If we assume 2K US price cut of available translate to $1,000 global, then half of this offset by cost improvements, then 500 cut of gross profit equates to about 1,000 BPS of gross margin pressure, implies 19% quarter two to quarter three auto gross margin. Basically, if you do the math on that. So they're saying the ratio between the price cut to the margins is for every price cut that's done, it's about $500 of profit that is going into the vehicle that Tesla gets themselves, which is about 19% quarter one to quarter two to quarter three. And so a statement from Tesla uh, themselves, or a statement that was made, says, "We have been cautious about the profit impact of Tesla's price cut, writing the lower prices are negative overall for Tesla, less negative for traditional automakers such as GM and Ford, given that they are now likely to lose money or even more money in the interim on EVs, although they have other profit centers to offset such losses. And the most negative of all the pure play battery electric automakers with Tesla, such as Rivian, is that they too are likely to lose more money on EVs, although they do not have profits elsewhere to offset their losses." So basically, they're saying everyone is switching over to EVs, but Ford and GM kind of have the structure in order to manage these losses. Ford made their own EV section, so they kind of subdivided the company. So one portion of the company is focusing directly on EVs. And even though the amount of vehicles that they've sold EV wise has not equated to the amount of EVs that Tesla has sold, it's saying that even that Tesla, being, largely getting their profits from being an automaker, doesn't really offset the amount of money that they're going to be losing on vehicles. I slightly agree, slightly disagree with that. I think Tesla is more than just an auto manufacturer. They do power, and if you read the Master Plan 3, they have plans to do a lot of other things that could help bring in some more costs for the company. They also have the tax credits that they're getting for battery production, which I think really isn't factored into a lot of these numbers. So that's something to look at for as well. And similarly to last quarter, analysts are keying in the word demand as it pertains to production and backlog. In quarter one, Tesla delivered around 423,000 vehicles and produced about 440,000 globally. Analysts at Evercore, for instance, would like to hear an indicator of how Q2 deliveries are tracking in order to backlog and how order to mitigate the backlog, and is the backlog itself growing. And so looking further, some of the things they're going to be looking for Tesla is the dates and the ramp up of the Cybertruck production, the latest information on the Gigafactory in Mexico, and then how they plan on increasing the demand for, or increasing production for, the demand of EVs, and is the EV market in general kind of at a slow down rate. So it's kind of a lot of things going on at the same time. You have potentially a slowdown for demand in EVs, but then you also have the tax credits for EVs from the government, and then you have Tesla as a company kind of going into a lot of different areas in their Master Plan 3. I don't think that's a measure to stray away from producing EVs, but it's a great way for them to diversify their entire asset class. Cybertruck, I think, is a big thing. A lot of people have been waiting on Cybertruck for a while, so having a plan for that moving forward and that coming into market and people starting to receive their delivery of Cybertruck, I think, will help as well. And then their plans for the Gigafactory in Mexico and how they plan on increasing this production to get rid of backlog, and then fixing the margins. I think margins was kind of the highlight from this earnings, with the margins being around 19.3% opposed to the 20%. I think that kind of was a gripe for Wall Street. Wall Street kind of really had it out for Tesla, in my personal opinion. They are still profitable as an EV company, and are kind of light years ahead of a lot of the other EV companies as far as technology is concerned, and kind of started off early. That's been their main focus. Their technology is a lot better, but there are a lot of different factors to look at. They're also not the only EV company that's out there. So I think, with you being the market leader of EVs in the world, you're kind of scrutinized a lot harsher than some of the other companies like Ford or GM. And that's something that comes with the territory. So I think ultimately, it's kind of an overreaction, in my opinion, of the sell-off of the Tesla stock, which is currently at 169.64 at the time of recording this. I think it may potentially bounce back. There are a lot of people who follow Tesla in general. There'll be a lot of videos that are out there talking about what's going on with Tesla. I think if you're a long-term Tesla buyer, this really isn't shocking news for you, and it may be a great buying opportunity while there's an overreaction from Wall Street in the market. I think also globally, the market's trying to fight off a potential recession coming up, so that's something to look at as well. So ultimately, as earnings season shape up, there'll be more earnings that are on the horizon. You have other companies like Apple, which is moving into India, opening their first facility in, I think, Mumbai. So they've kind of been on the opposite spectrum as far as, publicity. They've kind of been on the positive up end, moving a lot of their facilities or transferring from China to India, starting to mobilize more into India. And I think the market is looking at that as a great transition for them. So it's not all bad in the market. And I say this, is not really too bad of a situation for Tesla. I think they still have the lion's share of EVs. And I think, if they can get their margins up, they'll continue to be, beating earnings moving forward. So drop a comment down below. Let me know what you think about the earnings. Was it good? Was it bad in your opinion? Where do you think Tesla will go from here, target price wise? Will it go back up to its level of like 183? I've seen some levels of 242 as a potential high value. Where do you think it will go from here? Hopefully that information helped you all out, and I'll see you guys on the next one. Peace.